Hello and welcome to the Global View on this Wednesday. I'm Andrew Gagan. Good to have you with us again here at Ausbiz. Let's check what happened overnight. Global shares edging higher in choppy trading as markets awaited details of US President's reciprocal tariffs. Wall Street mixed there on the last day of the quarter with investors hesitant to take positions ahead of the tariff announcement. The March quarter, in fact, saw top global corporations experience the largest quarterly erosion of market values in nearly 3 years. That's according to LSEG data, with the top 10 global companies seeing more than 13% decrease in their market value. Stocks, specifically Tesla, plummeted around 35%, Broadcom losing 27%, Nvidia 20% in market capitalisation. However, overnight big tech advances were led by Tesla, which climbed ahead of its first quarter vehicle deliveries report, with other Mag 7 stocks rising, including Amazon, Microsoft and Meta. Johnson & Johnson fell with a US bankruptcy court rejecting the company's $10 billion proposal to end tens of thousands of lawsuits, alleging that its baby powder and other talc products cause cancer. Delta, American and Southwest Airlines all dropped as analysts downgraded stocks amid concerns that the economic uncertainty could disrupt both business and retail travel demand. Shares in conservative news outlet Newsmax soared following a more than 700% surge in its New York Stock Exchange debut on Monday, and AI startup CoreWeave, which debuted last Friday, climbed to trade back above its IPO price. Well, the Trump administration has drafted a proposal to impose tariffs of around 20% on most imports to the United States. That is according to reports in the Washington Post. President Trump is reportedly considering using trillions of dollars in new import revenue for a tax dividend or refund. Meanwhile, there are emerging signs of stagflation in the US, with the latest economic data showing US manufacturing contracted in March after growing for 2 straight months, with the ISM PMI dropping to 49 last month. And a measure of inflation at the factory gate jumped to the highest level in nearly 3 years, amid that rising anxiety over tariffs on imports. That saw the US Treasury yields fall, the 10-year down around 9 basis points to 4.15%, and the 2-year dropping some 5 basis points to 3.86. The Japanese yen and US dollar, they edged higher as investors move into safe haven currencies ahead of the reciprocal tariff announcement. And the Aussie climbing back to 62.9 US cents. That's after the RBA left rates unchanged as expected. Bitcoin back above 85,000 US dollars. Oil prices, they've edged lower as traders prepare for the tariff announcement. Brent futures down to $74 a barrel. Copper's off around 1/3%, while iron ore is up more than 1% to 104 US dollars a tonne. And the gold price taking a bit of a breather amid profit taking, with US gold futures slightly lower at $3,146 an ounce. So let's get across what is moving, particularly those US markets at the moment. Howard Silverblatt joining us from S&P Dow Jones Indices. Howard, welcome back. Good to see you. Let's first start, given we're at the end of that first quarter, what are your observations of what we saw? It's turned out to be a bit of an ugly quarter.
Ugly quarter. First, I've got to take exception to the word choppy for today's trading. It's a bit more than choppy. It was a bit violent at times. It's a lot of uncertainty that's going on. Tomorrow's going to probably be worse, and that's before the 4 p.m. News conference that Trump's going to have on additional tariffs. But as far as the first quarter, it kind of was payback for the last 2 years. And considering the amount of uncertainty we had, and unknown, really was not as bad as the numbers say. Obviously, the Magnificent Seven have gone down significantly, but they, again, over the last 2023, 2024, and year to date, they still make up a big part. But it was the uncertainty that did it. Again, going into the election, from the election to year end, and even into the January, we made a high on February as well. Things were good, but the uncertainty over the tariffs, over the policies, over employment, and the underlying economy have added to this. So given all those, the pullback, not that bad. I realize it's not good, but it could have been a lot worse. But again, we've got a lot more volatility going ahead. We had it today. in the market. But again, we did end up with a nice profit. We were on the positive side. That's because the feeling is that once we get more news tomorrow, which will be after the close of the market, markets may be able to settle in. They may not like what we see, and there'll be a lot of reallocation for the stocks that will benefit, but at least you know what it is, and you can then chart the course. We're having a difficulty with commitments by companies because they're not sure what's going to happen as far as tariffs, supply chains, taxes. So we need to get some facts on the table at least and move on from there. So choppy is going to get even worse going forward.
Yeah, well, certainly investors, markets, corporations, they all want certainty. That's what they're looking for at the moment. Now, also, I mentioned there, Howard, just as far as the latest economic data out of the States, some worrying signs just in terms of the potential for stagflation. What are you making of that data?
The data's starting to show signs, obviously. The employment is the most important one. As long as people have money and they have jobs, they could choose to increase their savings, spend less, buy certain things in different stores, but they're still employed. And it's not costing the government unemployment numbers. So that's the main one that we're watching. We had the JOLTS today, which is the number of openings in the U.S. that went down. Friday's another major one. We think we'll start to see some of the layoff numbers in the employment on Friday morning. Right now, unemployment in the U.S. is pretty good, 4.1. We're expecting it to go to 4.2. But that's before we get most of the layoffs that we're starting to see. So that's the big concern on there. Additionally, with higher prices, you can get literally inflation coming in because of tariffs, as well as a higher unemployment. So you get a really bad scenario on there. The Fed could do whatever they want, but it's the employment and the higher tariffs that they'd have to be fighting on here. So there's a lot of concern. Again, the majority of the street is thinking that this is, including myself, that this is still negotiation. So whatever we get tomorrow may still be negotiations. The hope is that we could settle it and get some top line facts sometime this quarter, maybe by June, and then the market could settle down significantly and we could see plans coming in from corporations. But of course, the minute the street thinks they know what's going to happen, we'll start to invest, because to invest on what you think is going to happen, you don't wait for the actual paper to be signed.
Yeah, but of course, at the moment, there is that reluctance, particularly as far as corporations are concerned, to make any investment commitments. What are we seeing with those earnings estimates at the moment, Howard?
Q1 has come down. So from being another record a couple of months ago that it was estimated, now it looks like about a 3.5% decline going in there. That said, the whisper number is still somewhat of a break even, a bit more optimistic on there. But earnings, if you look towards the second half and into 2026, are showing double-digit gains. Basically, analysts have not pulled down, at least the bottom-up individual analysts have not pulled down the earnings numbers yet to incorporate tariffs or lower margins or lower consumer or corporate spending or government spending, which could also be in there. So you got to take those numbers with a lot of grains of salt, shall we say, the second quarter after quarter 3 and 4 and the next year. We have seen buys and sells come out. A lot of sales. You mentioned several of them on the airlines with the retails as well, and they've taken it. But the estimates, again, Q1 is going to be down. We'll be up year over year about 9%. So companies will push that number. But again, the forward numbers do not incorporate tariffs yet.
Meanwhile, Howard, no surprise that investors are seeking those safe havens in particularly currencies, but also gold.
Gold, materials, some energy, which is the best year. Gold's almost 31.50 today. It's gone up nicely in the last year. Of course, don't do a 5-year chart. You may not be as impressed. But we are seeing that go in. That was number two, on the inflows for Q1. Money actually going in. Short-term cash was number one for inflows. So there's more money coming into gold in there, and it's buying in there. Given how much has been going in there, it's surprising that it has not gone up even more. The expectation is for more because there still seems to be more buying coming in there, especially if we're going to get more turmoil over the next couple of weeks. But it's done well, as is some materials like energy, even though oil's only gone up a little bit.
Howard, great to get across what you're seeing. No doubt this time tomorrow we shall all be holding our breaths and see what the president reveals. Thanks so much for joining us on S&P Dow Jones Indices.
Take care.
Let's come back home, take a look at where we're likely to go. Another positive session is ahead just as far as what SPI futures are telling us. They're up 1/3%. That's after some very strong gains we saw yesterday. Stay with us. We are just a couple of minutes away from the open.